This video will help you understand how active and passive losses and gains offset one another. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. If you have active income or active losses or passive gains or passive losses throughout the year, by definition, you're going to have a net amount of either gains or losses in both categories. If you're proactive in your planning, you can actually use your mastery of this section of the tax code to reduce your lifetime total taxes that you'll owe the IRS. So in today's video, we'll walk through how certain gains and losses, either active or passive, can offset one another. So let's jump in. Now, rest assured, if you simply want to plan by default, your respective institutions will send you things like 1099s or 1099Ss that break down how much in total gains or losses you had throughout the year. Then you can either send that to your CPA or plug it into TurboTax, whatever, and it'll give you the end result. However, if there's a lot of zeros involved or you simply just want to take a little bit more ownership in controlling how much you're paying in taxes throughout the year, you're going to want to know how various gains and losses, both active and passive, offset one another. Let's first focus on passive activity, losses or gains, and then we'll talk about active gains or losses in a second. So passive activities would be things like buying and selling real estate, buying and selling investment securities, etc. Essentially, if you don't own the business or you're not directly employed by an employer, for example, it's going to be considered a passive activity. Now, I do think the distinction between active and passive is a bit of a misnomer because if you're spending all day long trading an investment account, while technically it'll be considered a passive activity, it's obviously something you're pretty actively involved into. Nonetheless, we're going to use the IRS's verbiage because this is what your CPA is going to tell you, and then this is what you'll ultimately, if you want to, do more research on, and this is how the IRS uses these terms. So like I said, let's first focus on passive activity. To build a foundation, whatever you invest into an asset is going to be considered your basis. Whatever that property grows to be worth in the future is going to be considered the fair market value, and then the difference between what the property is worth minus what you paid for it is going to be considered your gain. Or it's going to be considered your loss if the fair market value of the asset is worth less than what you paid for it. As far as passive activity is concerned, capital gains, which is the technical term for how much you've made on a particular asset, or capital losses, how much you've lost on the investment in a particular asset, can be further subdivided into either short-term or long-term gains or losses. Simply put, short-term capital gains or losses is going to be any gain that was recognized due to the sale of that asset only if you held that asset for 1 year or less. Long-term gains, however, are recognized when you sell an asset that you owned for at least 1 year or longer. But before we can go do some more proactive planning, we're going to need to know how these offset one another. Well, to determine the total amount of either net losses or net gains you had for the year, first what we want to do is offset like gains. For example, you're going to want to take all your long-term capital gains and minus out all your long-term capital losses. Vice versa, on the short-term side, you're going to want to add up all of your short-term capital gains and then subtract out all your short-term capital losses. Once you've achieved a net result in both categories, you're then going to net these two against one another to determine either how much in net long-term capital gains you had, net short-term capital gains, or net losses. For the purposes of capturing losses, however, the IRS doesn't actually care if you netted a short-term capital loss or a long-term capital loss. If your losses offset your gains, you've generated a net loss for the year. After doing all the math, if you end up with a net short-term capital gain, those short-term capital gains are going to be taxed at ordinary income tax rates. Not great. Generally, that tax rate is going to be whatever your tax rate is on your income, somewhere in the ballpark of 0 to 37%. If you end up with a net amount of long-term capital gains, however, that's going to achieve far more preferential tax treatment, namely either taxed at 0, 15, or 20%, or a combination of all those, but between 0 and 20%. So all else being equal, you'd rather net long-term capital gains than net short-term capital gains if it's the same dollar amount. Keep in mind, however, other taxes could apply. Your state might levy its own state-level capital gains taxes on either short-term or long-term or both. And the federal government might even levy net investment income tax on your gains, either short-term or long-term. They don't care. Net investment income tax might apply, and to further break down whether it does, I've got an explainer video here that does more of a deep dive. But just know there could be some other ancillary taxes that apply. For example, Washington State has a Washington State capital gains tax at 7% up to 9.9% for certain capital gain thresholds. But if instead of netting gains, either short-term or long-term, you end up netting losses for the year, you can actually use up to $3,000 worth of those losses to offset your ordinary income. Let's say for your passive activity, you generated $10,000 in losses. You can use up to $3,000 of the $10,000 to reduce your ordinary income as a deduction. You then get to carry forward the remaining $7,000 indefinitely in the future to either offset future capital gains you have, or if you end up with capital losses again, or a perfectly flat no capital gains or losses, to further reduce your income in the next year by $3,000. Now, a $3,000 deduction is not going to move mountains, but mathematically, it's a pretty favorable tax deduction because as opposed to deducting away from long-term capital gains, taxed at 0 to 15%, you instead get to deduct away your ordinary income, which is going to be taxed between 0 and 37%. So it's a pretty favorable tax deduction, and it's better than simply just offsetting long-term capital gains. Now, there is an exception to the $3,000 where it actually turns into $1,500, and that's if you're a married filing separately individual, which I guess makes sense because if two folks are going to file as married filing separately each, they're each entitled to a $1,500 deduction. But this is an example where passive activity losses can actually play a role in reducing your active income. Now, namely only up to $3,000 though. So active gains would be things like wages, W-2 earnings, things like that. Whereas active losses are generally going to be called net operating losses. And if you're not familiar with owning a business or you're not self-employed, the term net operating loss might be foreign, and it's okay if it stays that way because if you never end up owning an entity of some kind, you're probably never going to see net operating losses on your balance sheet. A net operating loss is generated when the business revenue is smaller than the total amount of deductions that are filed for that business's tax return, aka the business lost money this year from a tax perspective. Now, this is actually pretty common relative to cyclical businesses, or especially during times where businesses are facing a little bit of turmoil, they might have negative income for the year. This is also super common for folks that are just starting out their business. For example, let's say last year you sank $50,000 into opening up a frozen yogurt shop. And let's say your marketing really wasn't on point, or for whatever reason, you only generated about $10,000 worth of revenue in the fall of last year. Well, your net operating loss last year would be 40 grand. If last year you had a $40,000 net operating loss, this year you're allowed to use that net operating loss to offset ordinary income, assuming you have ordinary income to offset. And if you don't have ordinary income to offset, you're still allowed to carry forward your net operating loss indefinitely. There are a couple of rules though, however, for applying a net operating loss to reduce your ordinary income. Let's say this year, the frozen yogurt shop profited to you $130,000. And after you take some standard deductions or whatever else, you end up with taxable income of 100 grand. You're allowed to use net operating losses from previous years up to 80% of your taxable income for this year. Well, if your taxable income was 100 grand, the maximum allowable net operating loss deduction would be 80 grand. Now, unfortunately or fortunately, you don't need all $80,000 worth of net operating loss deductibility because you only had 40 grand of net operating loss deductions that you need to apply. But that would ultimately result in your taxable income going from 100 grand down to 60 grand. Keep in mind specifically, your net operating loss deduction is based on 80% of your taxable income, not your adjusted gross income, not your total income, but taxable income. So what can you do with all this information? Controlling when your business will lose money is probably not the greatest of business strategies out there. I'm sure there's a couple of special cases where maybe it makes sense to lose money in one year so that the next year it looks like you're super profitable. But for most of the small business owners I work with, generally we're not trying to lose money. Instead, I wouldn't focus on trying to time in the market when you're going to take active gains or losses. Instead, I would focus your ire on controlling when you're going to generate passive activity gains or losses. As it pertains to investment securities, this is where I see folks have the greatest amount of control as to whether or not they're going to recognize gains or losses. This is in comparison to a passive activity like selling real estate or selling the ownership of your business. While yes, you've got some influence around that, you probably don't want to wait more than like 2, 3, 4, 5 years or so. If you're planning to move in that direction, you don't necessarily want to try to tax time that too perfectly. You can definitely influence from maybe 1 year to the next, or maybe even a following year as to when you want to time the sale of real estate or your business entity. But those are a little bit more illiquid, obviously, than investment securities. And this is all in direct contrast to super illiquid investments, things like private investments or alternative investments or Delaware statutory trusts or private real estate investment trusts, things like that. Those are going to be very hard to tax time around. You have a little bit of influence, but it's going to be a lot harder than, say, just a straight up over-the-counter traded investment security. As it pertains to investment securities, if you know that this year is going to be a relatively high capital gains year, maybe you sold a second property or you sold your primary home because you're moving and you generated more than roughly 500 grand of capital gains on the sale, well, this year might be a very heavy capital gains year. If that's the case, you might want to hold off on liquidating maybe concentrated investment positions, or just hold off until the first of the year to do all your rebalancing for your investment portfolios. Now, retirement accounts, you don't have to worry about holding off on rebalancing those because the trades that occur within inside those portfolios are not taxed. However, non-qualified investment accounts or company stock that's been given to you outside of a qualified plan, those you're probably going to want to do some planning around before willy-nilly just diversifying or rebalancing. The reason you might want to consider waiting to rebalance or sell concentrated stock in a high capital gain year is not just because the dollar for dollar taxes are going to be high, it's because the tax rates you might pay probably are going to be a little bit higher than the average. For example, if by selling your secondary property this year, it sort of pushed you into the 20% long-term capital gains rate, and now maybe net investment income tax is applicable at 3.8%, well, you probably don't want to add further fuel to the fire because now everything you're going to sell, if it's attributable to long-term capital gains, is going to get hit with a 20% long-term capital gains tax and maybe a 3.8% net investment income tax, not to mention any state capital gains taxes that could apply as well. In fact, you might even look at selling securities that have lost money. That's called taking losses. And in years where you have both a combination of losses and gains or just losses, there's a strategy called tax loss harvesting that can come into play. And I'll link above to an explainer video on that. And it's essentially the concept where you purposely generate losses to offset capital gains. For example, I'm thinking of a client that's going to retire in 2 years. She has 500 grand of Microsoft stock with a mid amount of basis. I think basis is roughly half the portfolio. And as much as we want to diversify out of that stock and build a portfolio of index funds, I'm actually recommending that she hold off on selling a good amount of that until she is not in Washington State anymore and when she stops having an earned income, because her tax rate on long-term capital gains will be much less, not only because she's not in Washington State anymore, but also because her total income combined is very low compared to now, meaning her long-term capital gains rate, I think effectively is going to be like 6 or 7%, as opposed to 15 to 20% that it would be today. And I'll link above here as to how capital gains and ordinary income play together to determine what tax rate your capital gains fall into. So from a calls to action standpoint, I would say if you have non-qualified assets on your balance sheet with embedded gains or losses, you should proactively think through how you're going to sell out of those to minimize your tax consequences. From a tax timing standpoint, it might make sense to hold off on recognizing a bunch of sales today and maybe wait till the turn of the year. Maybe next year will be a lower tax year, or maybe this year is the low tax year and you better knock out a bunch of rebalancing before December 31st. Generally, you want to sell things once they've achieved long-term capital gains nirvana, and you want to sell either things that are at a short-term capital loss or a long-term capital loss. You generally just don't want to recognize short-term capital gains because those are going to come with higher than normal tax rates. Hopefully that was helpful. If you have further comments or questions, feel free to get in touch on the website. We had to pause comments for now, so sending a message through the website is probably the best strategy. Have an awesome rest of your day, and we'll talk to you later. Bye.